What's up, everyone? Welcome back to the Idiot Investor Guide channel with your host, me, Guy Davidson. Today is episode 3 of my Hatch portfolio journey and a few changes. So I'm going to take you through why I've sold some positions, why I've bought other positions, my change in ETF versus stock investment on the Hatch platform particularly, and if you haven't seen it already, I've done a stake versus Hatch portfolio breakdown. So basically looking at the costs of investing through each platform from New Zealand to US. And I'll tell you at the end what I'm planning to do and which platform I'll probably go ahead with in the future. Let's get into it. So if we look at a quick snapshot of my Hatch portfolio as of the beginning of June, I've got about $3,000 in US dollars in my portfolio, and almost at $400 returns US, which is about 15%, so that's good. Over time, you can see here it's slowly on the increase, still fluctuating a bit, but we are definitely going up. I've switched and sold out of a bunch of my ETFs, and I'll tell you why. So I did previously have basically the US 500 for both iShares and S&P. They were my two positions that I had in ETFs alongside the Global X Super Dividend Fund, which I still have. The reason why I sold out of those is that I'm going to be investing in ETFs through Sharesies for now, because there is no transaction fee. So through Hatch, I'd pay a transaction fee every time I invest into an ETF. And Sharesies, there's no transaction fee for ETFs. So I can chip away and dollar cost average into ETFs through Sharesies with no penalty. And therefore, in the long term, I'm going to make more of an investment that way. Sharesies has a slightly higher management fee for funds than Hatch does. I've done a whole breakdown video on that, so look at my Sharesies versus Hatch ETF investment video. But essentially, for the little amount that I'm investing for now and the frequency, better to invest through Sharesies for my ETFs. So I sold out of the two 500 positions and reinvested them both into the Global X Super Dividend Fund, because the dividend fund pays monthly, which is great, and it's actually super high percent at the moment. I think it's around 12% dividends, which is awesome. So that's an option that's not available in Sharesies, so I thought I'd just reinvest that money into there so I can get some constant dividend income coming through into my Hatch portfolio. Looking into the different companies now, my Tesla percentage looks like it's gone down a bit. It actually hasn't. It was up to 80%, I think, of an increase. And I was talking to a friend about this. We were both sort of watching it, and it kept going up, and we were sure it was going to go back down because of everything that's going on in the US. But, at the end of the day, we should have just been chipping away into it as it went along. So I've decided to pull the trigger now and invest a bit more money into it. And if it drops, then I'll invest more money into it again. But Tesla's one of those stocks that I think has great potential for future high growth. If you haven't watched my Sharesies number 3 portfolio journey, check that out, because I talk about I'm trying to rebalance the barbell. And what that means is essentially I had too many investments that were sitting in the middle ground of not a lot of potential future return or exponential growth in the future. What I really want is having a large proportion of my investment in the safer, less volatile ETFs, and then having a smaller proportion in a few really high growth potential stocks. So I don't want to be messing around in the middle ground where it's high risk, low reward. These two companies, Pinduoduo, hope I said that right, PDD, it's pretty easier, and Fiverr. So a lot of you will know Fiverr. I was a bit late to jump on the Fiverr bandwagon. I recently started looking at this app called Simply Wall Street, and it's quite cool actually. Like, it has some really in-depth analysis of stocks. Now I've been looking at what are some high growth potential stocks, and these are two that it suggested. I know Fiverr's been doing really well, and Pinduoduo looks like it's sort of the Chinese equivalent basically of Fiverr. So they're both e-commerce platforms basically. So, with the lockdown and everything going on, people like myself at home either making YouTube videos or a lot of people are creating their own websites. So my brother's set up a website called Only Golf. So if you are in New Zealand and you want to buy golfing equipment, go to Only Golf. I'll put a link below. Essentially what I was going for is, this is something that people are likely to be investing in at the moment, making their own websites, and that'll should have a spike. I might have bought it at the spike, to be honest, because I was a bit late to the party. They've both been up and down a little bit, not seeing the high exponential growth they did. But if we go into them, you'll be able to see that in the beginning, when COVID all started going down and everyone was locked up and thinking of what to do, they actually both had some really solid increases. So, if I'd bought in somewhere around March, it would have gone from 30 to 60, so that would have been double the investment already. And Fiverr's similar, so it was a bit of an emotional purchase, a bit of a knee-jerk reaction, thinking everyone's doing it. But I kind of figured that over time there's still potential for it to increase. Maybe not as much as it has, because if you had gotten to Fiverr, it went from $20 to $70, like that would have been a really decent increase on your investment. So far for me, it's not doing so well. I've bought kind of at the peak, but I'm going to leave money in there and see how they go over the next month or so. That may have been a mistake, but we'll find out. I mean, this is what I was saying in my Sharesies number 3 video. I'm trying to get to a stage with my investment now that I put a bunch of stuff in the safe end. So, majority of my investment goes into ETFs and more safer, less volatile investments. And then the other side of the barbell is going to be a few more gamble plays. So, definitely not certain. And there's a lot more chance of a high reward. But I could also lose all my money I have invested in those. So Fiverr and Pinduoduo, for example, they don't really have a historical benchmark of doing particularly well. They've just spiked recently, and so it's a bit of a roll the dice play to see if that trend will keep going up and trying to significantly increase the investment I put in. And that's why with Pinduoduo, for example, I've gone in $500 because I don't want to limp into these positions either. I want to put enough money in that there'd be a significant return if they do come off, but that it's not going to break the bank if they don't. So, if I lose that $500, so be it. But if it does continue on its trajectory, I stand to make quite a bit of money. So that's a little insight into the brain of an idiot investor. That's where I'm going for at the moment. Alphabet's just still trucking along. I think I've put a bit more money in there recently. Alphabet and Tesla. Alphabet I see is going to be more of a consistent growth stock, but I do think it'll just continue that trend. And I also got into the old gaming ETF. So this is one that's not available through Sharesies either, which is why I invested through here. Just seemed like a good idea. I put a bunch of gaming sort of outfits in my watch list to look at whether to invest in them or not. But then I just decided, I'm actually just going to put it in the ETF. It'll give me the average over the different gaming outfits, and it's easier than trying to track one or two and figure out which one's the best to invest in. So that's doing all right so far, 4%, nothing to write home about, but it's up. It's on the up and up, and I think it will keep increasing. Again, that would have been great if you'd got in before everything happened, because there was a huge increase in many of the gaming platforms because everyone's all of a sudden downloading and playing video games because they're in lockdown. You'll notice, looking at the state of my watch list, that I've started looking at quite a few different sort of tech type companies. They seem to be the ones that are doing really well through this lockdown period. So, it's online document storage, it's digital CRMs, it's e-commerce platforms, gaming platforms. So, it's all stuff that people can do if they're still at home or in lockdown, or It's just, I think, giving people a bit of a kick up the ass to say, what if you can't access your office? What if you can't access your physical storage or your physical work environments? Like, how are you going to have that continuation through a crisis like this? So a lot of people have realized that they really need to invest heavily in these areas for their business, and gaming for people that just want to kick back and relax. StoneCo is a Brazilian payment system that Simply Wall Street was suggesting was a good option. I've actually invested in it in Stake already, and if you haven't seen my Stake First hatch breakdown, go check that video out. I'll put a link to it at the end here. Chances are, I think I'm actually going to go and move my investment to Stake, purely because they have no commission trading, so that you don't get penalized for the frequency of buying and selling stocks. It does have a higher foreign exchange fee, so when you put money in the platform and take money back out, it charges double as much as Hatch does. But if you go to my Stake First Hatch breakdown video, I've created a spreadsheet that essentially breaks down the fees, so you can go and see what works best for you in terms of your investment style, which is going to be more beneficial at the end of the day. But for me, because I invest smaller amounts more frequently, I think Stake is going to be a better option for my investment. So I'll leave what I've got in Hatch, and definitely doesn't mean I'll be moving for good, but I think when I go to invest in US stocks and US or ETFs that aren't in Sharesies, I'm going to start doing that more so through Stake, because they don't charge a transaction fee. That's it for now, everyone. So thanks for tuning in once again to the Idiot Investor Guide. If you want to continue following my Hatch journey, you know what to do. Like, subscribe, leave a comment if you have any thoughts and feelings on how I've changed, because my investment has changed significantly since the last update. And definitely go and check out that Stake First Hatch breakdown video, because I am assuming that many of you are in the same boat as me and do smaller or more regular investment. So the transaction fees in Hatch might be stinging you more than they should be, and Stake might be the way to go. So anyway, that's my 2 cents. Stay tuned and go and check out my Sharesies Portfolio 3 if you haven't already. And I've also done a series on how to invest $10 a week. So go and check that out if you do want to get into investing, but you don't feel like you have enough money to play with. You always do, and Sharesies makes it very available to be able to invest smaller amounts of money. Get your foot in the door. It's always worth doing. So until next time, we'll see you here on the Idiot Investor Guide channel.